There's a risk on the infrastructure side, and there's a risk on the systemic institution side. For anybody to say, if Citadel shut down today, even for a day, that means 26% of all U.S. equities volume in 8,900 listed securities would stop. It executes 47% of all U.S. listed retail volume. It represents 99% of the traded volume of 3,000 listed options. To say that the system would work perfectly fine if all that evaporated today and competitors come into the market, that may ultimately happen, but until it ultimately happens, you're going to have a systemic event. And to deny that is to deny reality.
Thank you. The gentleman's time has expired. I now happily read
from a coalition of organizations interested in our tax system in opposition to the imposition of a financial transaction tax. And the second letter is dated March 17th from the Security Traders Association, also in opposition to a securities transaction tax.
Without objection, such is the order.
Thank you, Madam Chair. This has been, as I said, such a very interesting discussion. I really appreciate the extensive discussion we had on securities lending. I think the committee took away good information there that we can ask the commission to follow up on. And I think we've had a lot of discussion about best execution and the obligations under best execution, that it is a mandate on the part of all market participants, and that the SEC in their exam process in this current period will be looking at that as a special exam focus. Those are helpful points. Dr. Pivovar, there were a couple of points made I thought I'd get your comments on. Mr. Sherman asked about the ultimate cost, of course, in a retail trade is the spread between the bid and the ask. There's no doubt about that in a non-commission world. So I would say, does the competition among market makers under payment for order flow or not really improve that spread and thus lower the cost to retail investors?
Thank you, Congressman, for that question. We do have some insight into that. So as some people have mentioned, there is some transparency on this issue. So the SEC requires each of the market makers to file execution quality report in the language of the SEC Rule 605 reports. And so we can see, for example, for Citadel is the one that comes up. We can see for them or whatever any other market maker has to put out their statistics, and we can look at things like the speed of execution for various order types and what's called price improvement for those various order types. So we can actually see, measured against the national best bidder offer, whether in fact they're offering net price improvement, whether they're executing at the spread or whether they're executing outside the spread.
Yeah, that's helpful. And also, Mr. Sherman talked about the lit market, those quotes that go across an exchange. But as noted by our friend from the New York Stock Exchange this morning, all quotes are presented at retail in milliseconds, whether they took place off the exchange or on the exchange. Is that correct?
That's correct.
Yeah, thank you. I also was concerned, my friend Mr. Green from Texas made some comments about Citadel, and we had obviously some discussion just a moment ago about Citadel securities. And I was curious as to your views about the separation of businesses owned by Citadel. So Mr. Green's allocation, I don't want to put words in his mouth, is that somehow Citadel could use the information that they garner from being a market maker, payment for order flow, understanding the stop loss position in a number of names, and somehow trade on that information over at Citadel's hedge fund. Really, I found that shocking. That's against the law, is it not, Dr. Pivovar?
Absolutely, it's against the law. The SEC has put in place a number of restrictions, and so effectively, the hedge fund and securities market making divisions at Citadel have to operate separately. The SEC regularly examines to make sure that those that they've put in place proper protections in there, and if they find that any firm is violating those, they will vigorously enforce them.
Yeah, thank you, Mr. Gruchik. I really appreciate your testimony. I really enjoyed learning about your company today. We had a lot of discussion about the sales practices of Robinhood in the previous hearing. Quickly, could you address your policies on low dollar stocks, not penny stocks, but even if they're exchange listed, what your position is there and how you qualify your investors for either options or margin on your platform?
So we don't yet offer options on our platform. I have a lot of experience trading options, and we're thinking through how to best do that. We've taken note of the issues that have occurred at Robinhood and in general with retail investors accessing options markets.
Thank you, Madam Chair. I may submit some additional questions for the record. I want to thank the panel for their participation, and I yield back.
Thank you. The gentlewoman from Iowa, Ms. Axney, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, witnesses, for being here today. My husband and I have a digital design firm, so one of the areas that I've been focused on in regard to this is some of the newer brokers having designed their platforms and how they've done that. Dr. Bogan, you've done some tremendous research in behavioral finance. Just a real quick question to start. Can app design influence what decisions people using that app make?
Thank you for the question. Absolutely. App design and the way the platform is designed and the user interface can influence the type of decision that a retail investor makes almost on an unconscious level. And so I want to make a clear point. There is a difference between, retail investor access, which is great and provided by the apps, retail investor environment, which kind of is ease of use, and retail investor manipulation, in that there are certain behavioral science techniques that are used to trigger investors to behave in a particular way that may not be in their best interest.
Well, and so that's why Robinhood has behavioral researchers, correct?
Well, I can't speak to why they have behavioral researchers, but I can say that some of the features of their platform have been shown in research to elicit particular behaviors like more trading. For example, they have a list of kind of the most popularly traded stocks. That brings attention to particular types of stocks. And we know from the research that just having attention to particular stocks increases trading in those stocks, whether or not it's in the best interest of the investor to do so.
So as you mentioned there, it increases trading. And do you think that encourages savings and investment, or do you think that just encourages a greater tendency towards more trades?
Yeah, so there's a difference between investment and trading. And so just trading multiple times a day for trading's sake, the research is very clear that that is never in the best interest of a household. Buy and hold is the conventional wisdom, and so buying is fine, but this multiple trading and churning portfolios has never been shown to be beneficial to a retail investor.
Well, I appreciate that. I'm especially concerned about this given the fact that Robinhood's incentives are so heavily weighted on making sure that their users trade more, because that's what puts money in their pocket. Mr. Arnook, Robinhood has said that if its payment from market makers like Citadel is based on a percentage of bid-ask spread, can you explain why that's different from other firms and how that incentivizes Robinhood to have their users trade wider stocks or even riskier products like options?
Thank you for the question. I really appreciate it. First thing we should notice is that 92% of Robinhood users' trades are outside of the S&P 500, which is to say that they're in stocks where the spreads are 5 times as wide as they are for the S&P 500. These are widespread stocks. At some point in late 2019, Robinhood understood this and renegotiated the way they collect payment for order flow from the other market makers. It's always been a fixed mil per share. In other words, 15 mils per share or 20 mils per share. That's how it's always been done. But presumably because Robinhood noticed the trading patterns of its users, they negotiated to instead receive a percentage of the spread. So this is an amazing misalignment of interests. The Robinhood trader wants the stocks they trade to have the smallest spread as possible. The market maker who's buying the orders wants the spreads to be as wide as possible. And Robinhood, their agent, the broker, wants their spreads to be as wide as possible. I think that's fantastic in a negative way.
So Massachusetts found that 68% of Robinhood's options approved users in the state had limited or no user experience. When you talk about this, the options and the risk of the spread there, what do you think is going to be the outcome for 99% of these users who don't have